Pessoal, tudo bom? Hoje, dando continuidade a mais um episódio das entrevistas com gestores internacionais, a gente trouxe aqui um convidado muito especial, diretamente da Wellington, né? Ele é o representante da Wellington aqui no Brasil. Estamos aqui com ele, Ronny, diretamente da Suíça, e também com o nosso sócio e head institucional aqui da Levante, o Eduardo, que está junto comigo aqui para conversar, bater um papo com o Ronny, entender um pouco mais como é que funciona a Wellington, né? Ele veio aqui por intermédio da Schroders, a Wellington e a Schroders tem uma parceria e a gente vai entrar um pouco mais nesse detalhe aqui com vocês, espero que vocês gostem. A conversa vai ser toda em inglês, porque o Ronny não fala português, então fiquem tranquilos que a gente vai traduzir tudo para vocês com algumas legendas aqui, tá bom? Ronny, thanks a lot for your time here.
Thank you much for welcoming me.
I'm honored with your presence here to meet, in order to get to know how our work here. And I also would like to thank Lucas, who made this presentation, this meeting possible. So thank you, Lucas, whenever you are. And Ronny, I would go just in order to the audience to get to know you better. I will let you introduce yourself. So, how long have you been at Wellington? How did you get there? And what is your role today in Wellington?
So first of all, thank you much for having me here. It's absolutely a pleasure to be with you here and discuss a little bit about Wellington, Pagosa. And so first of all, maybe to start with, I've been already for 5 years at Wellington. With that, I'm rather still a newbie because Wellington is a private partnership. Usually people are there quite long. So on average, I guess people are there up to 20 years. So still, I would say on average to my colleagues, I'm still quite new. I got there five years ago, and I came in originally from Bank Julius Baer, which is one of the largest private banks in Switzerland. Already back then, I was focusing mainly to be a kind of investment specialist, particularly also focusing on alternative investments. So helping the bank, helping clients to understand alternative investments and particularly also how to position the portfolios. So then I came to Wellington 5 years ago, particularly also because Wellington generally has an institutional background, but wanted to grow the kind of what we call the wealth business. So that means more directly than also with banks and where at the end the kind of private investor is behind that. So they were looking for people who can help them to help them in the communication, in the positioning of our big kind of platform we have to the kind of wealth clients. So my role today is a kind of investment specialist, particularly also on the alternative sides, where I have a particular focus on, and therefore in this role, this is quite exciting role, I would say, because it allows me to meet all our clients almost around the world, discuss our macroeconomic outlook, discuss our kind of asset allocation, discuss of how we do position ourselves, particularly also in the alternative investment space. So it's a very interesting job and a very grateful job, and of course I'm also looking forward here in Brazil to have the discussion about markets, which are always very exciting.
Oh, as I can see, since you arrived 5 years ago, you have still a long time to go, right?
That's correct. That's correct.
Nice. And as we understand, the Wellington and Schroders are working together in this partnership within Gaia platform, right? So I would like to understand a little bit more, if you could explain how does this partnership between Schroders and Gaia within the Schroders and Wellington, within the Gaia platform work in practice, And what are the responsibilities and benefits of each management house in this model?
Yeah.
Could you explain that for us, please?
Yes. I guess it's a quite important question. It goes also back to the DNA of Wellington. Wellington is a very much investment-led organization. We are not particularly the strongest on distribution side. We are really focusing historically on investments. So we're quite old as a manager, already founded in 1928. Since then, we run a multi-asset fund. We directly launched it before the Black Friday in 1929. But still, this multi-asset fund exists today, so it speaks for the kind of expertise and long-term orientation of Wellington. But our core focus is really, as a private partnership, we are focusing what we believe we can do most or best, and this is investing. So we are always looking for kind of partners which you can work with. You maybe also some of the people here know, of course, Vanguard. Vanguard was also back in the 70s, a little bit kind of a spin-off out of Wellington, because Jack Bogle was a partner at this time and then decided to launch an ETF platform called Vanguard. And also today, Vanguard, for example, the US has a big active business, and Wellington is the biggest sub-advisor of Vanguard. So many of the large Vanguard funds in the US, like the healthcare fund, they are managed by Wellington. So it's really in our DNA to be the manager, but many times the name of the fund is another name and not Wellington. And so when we look at our overall assets, we have more than around 1.2 trillion assets we manage.
That's huge. That's huge.
Quite large in US dollars, and roughly 500 billion out of that is sub-advised, be it with Vanguard, be it with Schroders, etc. And the reason for us also why we really highly like the kind of collaboration with Schroders is, first of all, we started, for example, here with the Pagosa strategy back in 2012 as an offshore fund. And then Schroder already had this very well-known Gaia platform and had the expertise to tell us what it takes to take an offshore strategy into a usage format, into a more liquid format. So they had already this kind of knowledge, and therefore it was a really great kind of partnership, or still is a very great partnership, because they have a strong distribution team, they have a strong, very well-known liquid alternatives platform with the Gaia platform, and we can still, as Wellington, focus on that, what we believe we can best, and this is investments, and therefore partnering with such a strong kind of distribution force and platform like Schroders has. So this is really the kind of core how the strength of Schroders and Wellington play nicely into each other. So we are doing everything that has to do, and our role is we do everything that has to do with investments. In this kind of sub-advisory mandate, we have kind of restrictions, what you're allowed to do, which we have agreed with Schroders. And within that, we are managing the assets, for example, for the Pagosa fund. But the fund itself is owned by Schroders, and therefore we have a quite long name, Schroders Wellington Pagosa Fund, but it really stands nicely for the kind of great collaboration we have with them.
Nice. And I think this is great because by the end of the day, when you have an investment fund that get together Schroders and Wellington expertise, basically it means that in order for this fund to be available for the investors, it has to go through the filters by each house, right?
Yep.
Nice.
That's correct.
Nice. And going a little deeper on management inside Wellington, when we're talking about Wellington, Wellington is a multi-asset allocator, right? I would like you to explain to us what are the key drivers for asset allocation within Wellington management, and how do you assess the risk return of different asset classes?
First of all, I would say we are a little bit special as an asset manager because we are, first of all, run in a partnership model, and secondly, we don't have a CIO. So you can say everybody can do what he wants. No, at the end, what Wellington really is a huge platform of research.
There's only good sides on it.
That's true. So we have a huge pool of research. We have more than 50 sector analysts on the equity side. We have more than 50 credit specialists on the fixed income side. We have a macro team of 20 people. We have an ESG team. We have a geopolitical teams, etc., etc. So we have at the end a huge kind of research pool, and then around it we have like a selection of boutiques. So then we have the portfolio manager teams around it. We have on the equity side a value manager. We have different value teams. We have different growth teams. We have tech teams. We have alternative investment teams, and all of these teams are acting like boutiques, having their own investment style, having their own investment strategy, maybe looking at the same kind of securities, the same kind of bonds or equity from different lenses. But all of these boutiques, they can pull the kind of research capabilities and research insights of the research pool we have. And then I guess this is really the strength at Wellington at the end. We try to bring together all these kind of different edges from the firm, the different PMs, the different researchers, at least once a day together in our morning meeting. So there we usually have the kind of slogan, agreeing to disagree. So if I am, for example, a
Is
tech
it an
investor...
open discussion moment inside the Wellingtons?
Yes. So for example, you would be our tech analyst. You would come to this meeting, you would say, I met last week Facebook and Alphabet, for example. These are my findings. I think now it's the time to invest in these companies because they have this and this metrics and these reasons. Then I may be the value guy. I also have recently looked at these two companies and tell you, no, I wouldn't do that because I think from this and this perspective, it's not the right timing to go into these two positions. So we really want to have kind of always challenging each other to get outside view, to detect blind spots in investment research of everybody to make our investment decisions better overall. And I guess this is really something which has really played out over many decades now for Wellington. We do these morning meetings, if I'm not mistaken, since the 50s or something like that. So more than 50. Yeah. So
yeah, there were no Zoom.
No Zoom calls. Yes, yeah. Even there already it started, I guess. And today, at this time, it wasn't just in Boston at the headquarters, but today we have 2 morning meetings. One is the kind of Eurasian meeting, which is all our researchers and investors in Europe and Asia have a meeting together in the morning, and in the afternoon when the US also wakes up, then we have the morning meeting together between Europe and the US. And therefore, I think we can really try to find new investment ideas, differentiated ideas, and always what we try to be is try to generate this alpha for our clients. And where can you generate alpha? It's when you have a different opinion versus the market, different opinion versus the consensus, and we always try to find that out in these discussions.
Nice. Yeah, I believe we can see results because, as you said, you do these meetings for over 50 years. And this is the huge difference from asset houses in United States or Europe, for example, here in Brazil. When you talk about assets here, assets management, the story starts around the 80s or the 90s. So we're talking like 2 or 3 Brazilian investment fund history when you talk about this guy here. Nice. I don't know if you have one question, Eduardo.
So talking a little bit more about the strategy itself, Pagosa Fund. What is the objective of the fund, and what is its investment philosophy?
Yeah. So Pagosa, first of all, is a fund of multi-strategy hedge funds. So I mentioned overall we're roughly a 1.2 trillion asset manager. So maybe around 600 billion is invested in equities, more than 500 billion in fixed income, and then also we have a sizable alternative investment business. We belong to the top 20 asset managers on the alternative side. And there we run a little bit more than 50 alternative investment strategies. So what we want to achieve with Pagosa since more than 10 years is choose out of the 50 investment strategies a kind of multi-strat hedge fund portfolio that allows us to achieve a couple of goals. First of all, achieve a consistent positive return stream through market cycles. A consistent return stream, doesn't matter how the markets are, somewhere in the area of net returns, mid-single digits in US dollar terms. This is our target. Then we want to achieve this return target with low volatility, very low volatility. If I look back, our volatility was even below 4% since we launched Pagosa. This is even much lower than fixed income, for example. And also we want to achieve these positive returns with very small drawdowns. So we want to be able to protect the capital of our clients also in tough times like we had in 2022. And then also very important comes diversification, because we want to achieve this return with a very low correlation and very low betas to structural asset classes like equities and fixed income. So if you put it together at the end, what is our target is, put it simply, strong risk-adjusted returns. We want to outperform, for example, a kind of balanced portfolio consisting of 60% fixed income and 40% equities with lower volatility, lower drawdowns, and this is what we have also achieved since more than 10 or 11 years since we started the Pagosa strategy back in 2012, and since then also we never had a negative calendar year.
And still talking about the Pagosa fund, could you explain the selection of the investment buckets within Wellington? From what we understand, there are more than 50 alternative strategies available. And how is this process of decision?
Yeah, I would say all the kind of strategy we are selecting must together fulfill or fit into the kind of return and risk profile I just explained. So very important is, this is a portfolio of today 9 different hedge fund strategies. And then if you want to achieve this goal, you need diversification, you need different return drivers. So we are selecting long-short equity strategies, for example, for Pagosa. So roughly half of our Pagosa portfolio is consisting of 5 different long-short equity strategies. Okay. Then we think very important in today's environment are macro strategies. So we have another 25% of Pagosa portfolio invested there, because macro strategies particularly and very important in difficult times like last year, where equity markets, fixed income markets don't work, because macro strategy have the beauty that you can achieve returns thanks to volatility in rates, in spreads, in currencies. So this is a very important thing. And then we also select strategies in the area of long-short credit strategies and market-neutral strategies. So we select this kind of hedge fund strategies out of our big platform of alternative strategies, which allows us best then to come out with decorrelated return sources. So we want to have that these hedge fund strategies we have in the portfolio have a low correlation to each other and help us to achieve this kind of return and volatility target we have there.
Very nice. You have another question regarding Pagosa?
Regarding Pagosa, no.
So let's talk a little bit more about outlook and the economy. What is Wellington's outlook for developed countries, especially US and Europe region? And also about emerging countries like China, emerging Asia, and Latin America, such as Brazil, in the short and long term. And considering this scenario, what would be the main risks and opportunities that investors should consider?
Yeah, big question.
Big question.
We can speak now half an hour. Where should I start? I guess on the macro side, one of our key message we have is we really believe we are seeing a regime change in financial markets. We do not believe that the same macro environment will come back as we have enjoyed over the past 20, 30 years. Okay. Meaning the kind of Goldilocks environment where you had low inflation, moderate growth, and the central banks that were supporting you every time it was a little bit more difficult in markets with easy money, etc. We believe this time is over. We also believe that central banks will move away from being a volatility dampener, like they have been over the past 20 years. As I mentioned before, if there were growth issues, central banks were reducing rates, pushing cheap money into the market. This is not happening anymore because inflation is back also in areas like the US, Europe, and maybe soon also in Japan. So central banks going forward will be more adding volatility to the markets because maybe they also have to increase interest rates in an environment where growth is going down to push inflation back to 2%, to the 2% target. And this leads us to believe that we will see going forward much more pronounced, much more stronger market cycles to the positive side, but also to the negative side. So we expect much more volatility going forward than we have seen over the past 10, 20 years. And really for us, the changing factor is inflation. We believe inflation is more sticky than the market today expects.
Okay.
I guess for us, the market was much more too positive in the first half of this year, believing that now the Fed and all the other central banks are starting to cut interest rates already this year. We think this is much too early because the underlying forces which lead to inflation globally are still there, and they are longer term there. For example, demographics are changing. Last year, China has reached a peak in the world in their working pool population. So since last year, China is losing the number of working age people they have. China had a huge disinflationary effect over the past 20 years since they joined the World Trade Organization, because every year they were adding more and more labor to the world's labor pool. They also deglobalization, geopolitics speak for more inflation, because we see a breakup of supply chain. Earlier days, in previous years, everybody was producing products in the cheapest place. Now, more other considerations than just costs come into play, like, for example, considerations of how secure is my supply chain. And therefore, there's some nearshoring, more going maybe to countries like Mexico, other parts of Asia, away from China. And this is also adding to inflation, because maybe the new places where you produce products are maybe not as cheap anymore as you could produce it in China. So these are certainly kind of key factors. And the last factor I would say is fiscal policy is changing, particularly active fiscal policy in Europe, but also in the US. So just say about Inflation Reduction Act, for example, the Repower EU. So everything what we see is there. A lot of kind of industrial policies are back in fashion, more fiscal stimulus measures regarding to the energy transition, but also more spending regarding defense, particularly also in Europe. And this kind of additional spending from governments is also fueling inflation. Therefore, we believe inflation is much more sticky. We don't look at headline inflation. What we look particularly is at the kind of service inflation, because the economies today worldwide are much more service-oriented and less manufacturing-oriented as in the past. And there we believe it's much harder for central banks to push inflation back to the targets. So when I speak, for example, about Europe, there really we see that the ECB has not yet done their job. They were rather laggards versus the US, for example, also laggards versus Brazil, which was quite early in raising rates. Europe was late. We still think the ECB has to do much more work to push back inflation to 2%. On the other side, also, we are optimistic on the shorter term period for Europe currently. We see first positive signs, particularly on the manufacturing side. So we see positive figures coming out of Germany, for example, with the latest reading or the latest figures end of July. We see positive figures from the manufacturing sector in Sweden coming back. So we could imagine that we really see a kind of a turnaround of the manufacturing sector in Europe in autumn this year, so say in September, October, for example. And the other part, which is really doing quite well, is the entire service sector in Europe. We see there kind of strong consumer figures. We see the European people are going out, are spending their money, and this has to do that the unemployment rate for Europe is one of the lowest levels in history. And therefore, we see a lot of positive support for the economy, particularly from the service sector and consumer sector. Another interesting story I would say today for us is Japan, where we are more positive in terms from an equity perspective as well. So Japan for us is really at the turning point. After 30 years of deflationary scenarios, we really believe that now also Japan will transition to a more kind also of inflationary environment. We see wage increases in Japan, and that with a speed we haven't seen for the past 30 years. And there's really something changing, because usually in the past 30 years, you had a couple of instances where inflation was starting to rise, but then people were stopping buying things. Because then the Japanese thought, okay, now the prices are rising, I just wait a little bit longer, then the prices come back. But this time it doesn't happen. When you look at the consumer spending in Japan, despite prices are rising out of Japan, they keep buying. So they don't believe that prices will fall back again. And this is a quite nice sign that the inflation is de-anchoring, so disinflation is de-anchoring, that we maybe are moving away from kind of a deflationary environment into an inflation environment with Japan, which is positive for growth, which is positive for Japanese equities as well, and also for us as investors, because Japanese companies have done a lot of things, in particular in terms of returns for shareholder. They were not the kind of shareholder friendliest companies over many years. Now there has really been a change. There's more shareholder value orientation in large Japanese companies, and therefore we think Japan, also basing on their leadership, tech leadership, robotics leadership, can be a quite interesting market going forward. Speaking about the US, we believe now, or seeing that the Fed is now doing a pause, a little bit assessing all the strong hikes they have done over the past 1.5 years, seeing how this is materializing in the economy. We should never forget monetary policy always works with a strong lag. Some say 1 year, some say 2 years. What certainly for us is the case is that US equities, from our perspective, appear expensive. When we look at the Schiller PE, which is a kind of smoothed profit versus valuation figure, when you look back over the past 20 years and look at the Schiller PEs, then we are currently at the 80th percentile, which means in 80% of the time over the past 20 years, US equities were relatively cheaper than they are today. And this is another sign that US equities particularly are very expensive versus European equities, where we see a fair valued market, or even in Japanese equities, where we see a strongly undervalued market. So therefore, if you take developed markets, we would say rather focus on Europe and Japan today. Also from a macro standpoint, we are rather short European rates and long European currencies, so the euro currency, and the same is also true, for example, for the yen, where we all rather would expect a stronger yen going forward. Maybe switching to emerging markets. I guess overall, many emerging markets, like Brazil, have done a very good job in terms of rising interest rates early, protecting the currency. With that also are now maybe already in a position to start early with cuts again, which of course is also beneficial for the economy. So overall, on a short to medium term, we are quite opposite on Brazil, for example. So we had already longer term kind of long positions, for example, the macro side on Brazilian rates. We are long, for example, also the Brazilian currency. So from our side, and speaking about Brazil, we are rather cautiously optimistic on the medium to longer term. We are there a bit cautious. Depends what will happen if growth cools down a bit in Brazil, what we expect. How will the government react on that? Will they increase fiscal spending? And then with that also loading up more debt burden for the economy, which could be quite negative. So this is something we are observing from a longer term perspective. When I look to Asia, I guess there's a lot of controversy, particularly around China. We as a firm are cautiously positive on China. We think the China recovery will come true after the COVID lockdowns we have seen, after the tech backslash, what we have seen in the years 21 to 2022. Valuations in China, particularly H-shares, so these are the Chinese companies that are listed in Hong Kong, is extraordinarily attractive. So they are the lowest valuation for the past 20 years. So therefore, it's as a starting point to do investments in China, the valuations are very attractive, and it's right now the time to do that. On the mid to longer term, we are, from the geopolitical situation, a little bit more kind of cautious when it comes to China. Particularly this kind of decoupling from the US, the kind of tensions over Taiwan, which is something which of course we and our geopolitical team is currently considering quite strongly and observing quite closely. The other big economy in Asia is India. With India, it's quite the opposite. From a valuation perspective, Indian stocks are rather expensive right now. But when you look at the medium to longer term, India is quite promising because we see the government doing a lot of pro-growth reforms. You maybe remember 3-4 years ago, they did the kind of demonetization. So they were really trying to dry up the informal black market, which now translates into a broader tax revenue base, for example, for the government. They are investing in infrastructure. And India today, for example, the private sector, which we believe will be much more promoted going forward, also from the government. We see that also that India, for example, is one of the biggest growth markets today for cars globally, for car producers. It's the biggest market, or the fast-growing market for airplane producers. So the kind of demand coming from India is very important, very interesting. I guess for medium, longer term, India is really a kind of a growth opportunity we don't want to miss. So this, I would say, is a little bit overall how the macro outlook is. I guess bottom line for us, very important as a global investor, is that you are prepared for more volatility going forward, that you are also prepared for diversify your assets. Different countries will be in different cycles. China will have a different cycle than the US will have. Europe will have a different cycle than maybe India will have. And then more and more global investments, diversified investments get much more important. I guess also what gets more important is stability, bring stability in a portfolio. You can do that, for example, with investments like Pagosa, who can bring you diversification and stabilization. You also have to look for alternative return sources, because this kind of equity bond hedge that worked very well in a multi-asset portfolio, being long equity, being long bonds, doesn't work anymore in the new regime, meaning we will have much more shifting correlations, much more positive correlations between equities and bonds. So you need new sources of diversification. Can be also macro strategies particularly because they are benefiting from higher volatility. So we guess this is something which can be interesting going forward for diversification and return enhancing strategies. And last but not least, also from our perspective, you should look at commodities as a good inflationary hedge overall. And particularly we see a lot of underinvestments in many commodities, in many metals, which are the necessary to really achieve the energy transition, to produce more batteries for cars, make sure we really can do the kind of decarbonization, the electrification of our society and of our economy. And for that, this is very metal intensive, for example, and there is not enough money going into these sectors to really produce the supply to meet the demand in the future.
In this scenario, maybe Brazil is one of the winners, right?
Absolutely. Yeah. So Brazil, Chile, other countries which have a lot of also metals and commodity resources are certainly an advantage. Geopolitics also plays a role. The Western world wants to be more reliant on Latin America, tries to reduce the reliance on China on the other side, so wants to work more with democracies than for example, with China, who already is using their kind of grip on rare earth materials, for example, to cripple the West a little bit.
I think your perfect explanation about Brazil was cautiously optimistic. Yeah, that's it. That's it. Yeah,
exactly. Whoa. And moving forward to another topic here, getting closer to the last question I have on my cheat paper here. How do you guys see yourself when we're talking about how does Wellington International differentiate itself from other assets management? And what do you consider to be the key success factor in managing funds on such an uncertain market environment as we just spoke?
I guess the answer to that goes directly back to what we already discussed at the beginning about Wellington. I guess one of our key success factors is that we are a private partnership, that we always have a very long-term view. So we are sitting in the same boat as our clients. We want to grow assets with them. We are not listed, so we don't have a kind of revenue targets every quarter, which we then have to report to our shareholders. So we have really a long-term view. We want to grow with clients. We are on the same side, there's the same inventation, to say so. And the other thing goes back to the kind of how we are structured with our boutiques and the big research pool, how we are doing all the kind of interactions with each other at the morning meetings or the macro meetings and all these kind of things, where we try to test and challenge our own investment view every day from anew to make sure that we make at the end the best investment solution. So we don't have a CIO, as I mentioned, who gives us the direction. We have to think on our own. We have to try and test it out on our own. We have to challenge each other. And at the end, and this is also now the almost 100-year history of Wellington has shown, this usually then turns out to achieve better investment results for our clients.
I think the long-term historic of the house talks by itself, right? I believe investment house only lasts because it does a good job, right?
Yeah.
And I don't know if Eduardo wants to say something else, or even you, Ronny, if I didn't approach something you don't want to you want to talk about, feel free or to leave a message to the people who are listening to us. And to close the meeting also, I would like you to explain to the investors where they can find Wellington investment funds here in Brazil.
Yeah. Just remind me if I don't answer all the questions. But first of all, message to the Brazilian investors or listening in. I guess.
You want to say, if you want to approach anything I didn't over the conversation, if you want to leave a message to anyone. And
I guess one of the key messages, what I also explained a little bit before, diversification, volatility going up, needing more for diversification. I guess this is also something for the Brazilian investor who has tendency, like other investors, being in Europe, in the US, everywhere, has a home bias. I guess, although Brazil is a really big country, I guess you also have to look abroad. You have to invest abroad. You have to diversify. You have to use the growth opportunities, the huge growth opportunities Brazil is offering you, but as well what other parts of the world is offering. So I guess diversification going forward will be key also for Brazilian investors. And they should also not look at just at the kind of local returns in local terms, but also do more diversification in terms of which asset classes they invest, which regions they invest, which currencies they're investing to. So I guess this would be a kind of a key message. Other than that, I guess we have addressed more or less all the things I would like to touch on. And there was a last question you had.
Where the investors, the Brazilian investors, can find the Wellington Investments Fund here in Brazil.
So the investment strategies of Wellington can be accessed over all the prestigious banks in Brazil. So we have, thanks also to Schroders, great relationships with all the top banks and private banking sector here in Brazil. So we are really working together with here the local industry. We really bet also on the Brazilian market. We think highly of that. We see strong growth in the country, and we are here to stay for a longer term and want to grow also with our Brazilian investors.
Sure, we hope that becomes real. Yeah, thank you very much, Ronny, for your time here.
Thank you.
Thank you, Eduardo.
It's really great.
And feel welcome to come back whenever you want. It was a great pleasure to having you here.
Thank you very much. Looking forward to it.
Thank you.